All right, we're going to try and go through my computer. Can anyone hear me through my laptop here on the table? Okay, we're back on that. All right, everybody speak loudly. We'll go through the laptop for today and we'll see if we can't get the mics fixed for tomorrow.
Cool. We'll just start over. Hey, everybody, welcome to the morning market briefing. It's Wednesday, January 18th, 2023. We do have some economic data coming in right now. The expectation for retail sales is for a decline of 0.9%. Last reading was 0.6%. Tom, I don't know why, but I just have this gut feel that we're going to come in cold compared to those expectations.
Yeah, I'm having real deja vu here as it relates to these numbers coming in. So the expectation was for a retail sales contraction of 0.9%. We actually came in under at negative 1.1%.
Wow.
And on top of that, we had a revision down of the previous month from a contraction of 0.6% to 0.1%. And the most important number is actually the ex-auto, ex-gas came in at negative 0.7%. And the expectation was actually for no change, for flat. And then on top of that, we also have the PPI final demand revision for December, which is the producer's price index. Basically, it was very cool. So we came in at a revised down from a contraction of 0.1% to 0.5%. And the headline number actually came down from 6.8% inflation on the producer side to 6.2%. So that's a move down from 7.3% in November. So that's not only is inflation coming down, but it's coming down faster even now than we expected, now that we've had time to look at the PPI number. So a lot of good news for the Fed this morning. Retail sales coming in cold, PPI revision coming in cold, bonds are way up, and I expect this to be very positive for the markets today, as well as hike expectations are probably going to come down in terms of what the Fed's doing in the first half of 2023 as well.
Yeah, this has to be right in the sweet spot of what the Fed's looking for as they try to approach a soft landing. We talked about that on the macro presentation yesterday afternoon, but this certainly reinforces the notion that there is a path to a soft landing and potentially widens that path. So good news there. We will hear from Jim Bullard, who's being interviewed by Nick Timmerhouse at 9:30 Eastern time. Tom, expecting anything wild from him?
I don't. He's kind of been in the camp of somewhere where the terminal rate is between 5.25% and 5.5%. So I would expect him, even with this data, to probably continue to hammer in that notion. I mean, if anything, this just gives the Fed more credibility that their strategy is working, and they can kind of claim victory and claim that they know what they're doing. So my expectation is for them to continue to, push that 5.25%, 5.5% is their terminal rate. They think they're going to be able to get there, pause, and then they're going to be able to have a soft landing. So hopefully no surprises. Bullard's been known to move the market, but we'll see what happens at 9:30.
We got some questions yesterday in the panel after the macro presentation about the housing market. We do have some data to discuss. Redfin has data active listings are at 712,000 in the U.S. for spaces, roughly in line with where we were in Europe. Significant moves. 3.8 months of supply right now in the market. That's mostly because homes are just moving slowly. Now, what are you seeing from a data perspective and from a theme perspective that might kind of indicate where the housing market is right now?
Yeah, I think that what we're seeing is that at the beginning of 2020, which is, for lack of a better analog, is the most normal market that we can look back to. If you think back to
Voice volume.
If you think back to late 2021 or 2022, we had significantly higher volume just rush that people were having for houses. So if you think back to where we were in early 2022, what we saw is that active listings were about 1 million active listings in the United States. Today we're at 712,000. So there's less inventory on the market. However, that inventory is sitting out there for longer. And so what the big takeaway there is that people want to buy homes. The mortgage purchasing index actually increased again alongside falling mortgage rates this morning. And Google searches are up 50% on a month-over-month basis for homes for sale. So people want to buy homes, but they can't really afford them right now because they can't afford the mortgage payment. People have these big down payments that they're willing to part with, but they can't afford the home. So we need more inventory of lower priced homes so that people can actually afford them, because at the mortgage rates currently, you can't afford what you could have at 3% mortgages. And ultimately that's the crux of the matter. We are seeing some price declines. San Francisco's average price is down about 10% on a year-over-year basis. Seattle's down 5%. Most of the other metropolitan areas are down 2 or 3%. And that's what we're seeing right now. I would expect some normalization of mortgage rates and the housing market as the Fed potentially normalizes over the course of the next 6 months.
We did hear from a number of companies on the earnings front, a little bit more on the industrial side. This could be wide spanning here. United Airlines at 4.5%. Man, this is my first time looking at a Zoom screen for this call in a while. Shout out to John and Glenn, the double trophies. Love that. But very strong quarter for UAL at 4.5%. Earnings per share came in strong. Revenue per mile pretty strong. Load pretty good. Fuel prices, even that, a little bit of relief there in terms of coming in at $3.54 per gallon relative to the expectation of $3.59. Good guidance. Overall, I mean, it's a little bit hard to nitpick this quarter from United.
Yeah, it's difficult to nitpick. United really countered our chest saying we invested while others did not, which really sets the stage for a strong rebound. They came out with earnings per share guidance for next year of $10 to $12 per share for this year. The estimate was $6 or $7 per share. So really good numbers there. A lot of it's on the cost side though. They're going to be flying more planes up in the mid-teens on a year-over-year basis. That's where they're getting the revenue from. Interesting, they are not building in any increase in total revenue per available seat mile, which basically can translate to they're not building in any increase on a yield basis, on an airline fare basis. So we're starting to see again the lack of inflation come through even to the airlines. Now that may be conservative. They may be lapping some unique periods with their credit cards, which gets lumped into that total revenue per available seat mile. Nevertheless, this is a remarkable change from what we've been seeing, and I'm interested to hear what their commentary is on this front when their conference call starts at 10 a.m.
Good deal. Also heard from JB Hunt down about 2%. Missed really kind of on all the headline numbers. Earnings per share came in at $1.92. The expectation was $2.44. Revenue came in a little bit soft. Ben, how would you kind of explain where JB Hunt is? And given the execution we've seen, albeit in a different industry from a company like United, how do you kind of explain why the stock maybe isn't taking it on the chin a little bit more?
I think weather definitely played an impact in terms of being able to move a lot of loads, especially in December. We had some of that extreme weather. So that's one piece, but pricing was down a ton. And pricing was down a lot, especially in trucking. On the rail side, it looks like pricing held up reasonably well on a relative perspective. But on dedicated trucking, pricing decelerated from 14% to 9%. On integrated capacity, you're talking about down 9% on a year-over-year basis. Weaker in terms of revenue per load on the trucking business itself. And even on the intermodal on the rail side, you're talking about 6% pricing, which seems attractive, but that's down from 26% growth last quarter. So we're definitely seeing a little bit of a decline on the revenue side primarily as a result of a deceleration in pricing. And that might not be great for JB Hunt in the short term, but it's really good for the economy. And this is music to Jay Powell's ears.
Awesome. We have quite a bit coming your way in earnings over the next couple of weeks. Tonight we'll hear from Discover Financial. Tomorrow we'll have Procter & Gamble and Truist, among others. Tomorrow evening, Netflix will get their chance to talk. Friday morning, Regions Financial, a bank that we've been looking at a little bit more as of late. So plenty of things coming your way. We'll definitely be back with lots of commentary on these companies. And also probably tomorrow, a little bit of a recap maybe on if there's anything real noteworthy from Buller's discussion. So we'll wrap it up there. Sorry for the technical difficulties. We will try to figure it out. We'll talk to you soon. We're not wrapping it up. Oh, everybody stay. Nobody go anywhere.
Test audio. All right, I'm gonna mute the laptop. We'll see what happens.
All right, talk to the mics. Mommy made me mash my M&Ms.
Check.
Anything. Good. John Glenn.
John Glenn says,
Okay, we're back.
We're back. Great work, everybody.
Boys are back in town. The boys are back in sound.